and welcome to another episode on OneSource Tax Provision Functionality. In today's session, we are going to talk about the tax rate change and how it impacts the deferreds. So if I just jump quickly into one of our units that we have active, I'll just filter here and I'll go to my main company, Unit 100, Dunder Mifflin. So if I go into the units details area, I'm going to go into rates. As we remember, whenever we're setting up a unit or setting up a jurisdiction, and we can pop into that afterwards, we need to put in what our current statutory rates are, our beginning and our ending deferred rates as well. So I'm not going to go through the FX in this particular episode because we have another session on that where we talk about the CTA and FX changes. Today, we're just looking at our statutory rate changes. So that's on our federal side. But if we've got other local jurisdictions attached as well, it's possible that we could have rate changes at that level too. And that would take into consideration any apportionment rate changes along with the statutory rate changes that may exist. So if we go take a look at this example that I have, this is the income statement view of the deferred roll forward report, one of my favorites, because what this particular view does is it tells you what portion of the change in your deferreds is related to P&L. But it's one of those reports that a lot of people probably don't understand as well as the traditional balance sheet roll forward view. So we're just going to walk through that. So if you have a rate change, as we know, when we are putting our, running our reports, our beginning balance is tax affected using the beginning balance rates that are in effect. So those rates that we entered into our unit detail screen for our beginning balance of the deferreds will get tax affected at those rates. Our ending deferred rates will impact our ending balance. So kind of how do we get from this beginning balance tax affected column to this ending balance tax affected column? I'm going to collapse this one down because we're not talking about the CTA in this session. So our beginning balance gets tax affected and we've got a rate change on our beginning balance because we have a new ending statutory rate or a new ending apportionment rate. So how does that fall out in this particular report? You will notice that there's an area called rate impacting items, and it goes into this column called total rate impact. We're going to exclude this deferred only just for a moment. I'll make that one kind of like a light shade of pink so we can kind of ignore that one. So if you have a rate change, first thing you will see is that there's a column called effect of rate changes on your beginning balance. And that's this, what's showing here is column E in this particular report, but it's also indicated by a column, a B dot effect deferreds. If you've got a change on your rate, what the system will do is it will take the difference between the beginning rate and the ending rate and multiply that by your pre-tax number. And that will show up in this column E. There's also another column called effect of rate differences. And this is actually the differential between your current statutory rate that is being used to calculate your current tax provision. So these are the temps that are going to show up on your tax return or the tax provision itself that goes into the return basis provision. So that's your current deferred flip. So these are calculated at the current statutory rate. But let's say in this example, our ending statutory rate is 17%, whereas our current statutory rate is 9%. So we have a 2% differential there. That's what's going to pop out here. And the reason this exists like this in this particular report is because of the fact that we typically think of current activity as having no P&L impact. It's because we booked, current expense on one side along with a potential receivable payable or expense benefit with an offsetting receivable payable. And on the deferred side, we book the opposite of that with a DTA, DTL with an offsetting deferred expense or benefit. And those should typically net to zero. So the way this report is built, it takes that into consideration. So in order to get from what that rate is to our ending balance rate, we put that differential in this column. Now that differential actually does have an impact and will affect your effective tax rate report when you take a look at that. So that's why these two columns are considered rate impacting along with the deferred only adjustments and go into your total rate impact. So if I highlight those three columns, I will get to my 693,117. However, the activity that has to do with current is a part of your deferred provisions. If I sum all of those four together, I will get my 167,546. It's just that this one does not have a rate impact. Now, what happens if you are looking at this from the balance sheet view? What does that look like? So in the balance sheet view, you will have one rate change column. Okay. And I know I said we weren't really going to take a look at the CTA today, but because I've run this in a reporting currency report, it is here. And so if it was just the local currency report, the rate change would include any, actually you wouldn't see the FX here. The rate change column would just be your change on your beginning balance. But if you are looking at it in a reporting currency, then the rate change is also going to include the impact of the FX. So it will be your rate change on your beginning balance plus any kind of CTA related to the beginning balance and any kind of CTA related to the change in the differentials as well. So those three end up being your actual rate change that you will see when you run the balance sheet view of the deferred roll forward report. Okay, and that's it on just the impact of tax rate changes on the deferred. Look forward to seeing you on another session. Thanks.